financial year self-managed super fund planning video, just to put a few things out there for you to all to consider over the next 2 weeks. So once again, that's myself. I won't go into the details other than I've been doing this for, it says over 20, but it's actually over 30, starting to show my age. Disclaimer, as always, we're not giving any financial planning or tax or investment advice here. Please consider taking personal professional advice. So what are some of the end of year strategies? Just in summary, firstly, you will all either have received or about to receive our engagement letter. That is an engagement letter from our accounting team that once you sign it, we then know you want us to look after you accounting wise going forward for your SMSF. So please sign that. We won't be able to answer any questions you have, technical questions on end of 30 year strategies until that is signed. So what can you do before 30th of June? You can contribute to the fund, concessional, non-concessional or other contributions. You can withdraw from the fund under pension or tris. And you can start preparing your paperwork for the accounting team and take a photo of your precious metals on a 30th of June newspaper or within days of that, if at all possible, not beforehand. It's got to be after 30th of June or after, and have that ready to submit to us. So a lot of people are starting to ask now, well, when is my annual tax deadline? And so put this out here so that we don't have to field these inquiries, because we've still got a lot of time before lodgement. For some people, if you were set up before 30th of June and you prepare your own tax return, which I strongly suggest you don't, the deadline is 31st of October. So that's the soonest deadline, and I strongly suggest people don't do that. We have extremely specialist software which costs us a bomb, and seriously dedicated and experienced long-term staff to do these. They're not easy. Even being an accountant for 30 years, I don't do my own. It's just not really a good thing to do. But if you set up before 30th of June and you're getting us to do it, the deadline is 28th of February. So that's why I say to people, don't panic. We have plenty of time. Realistically, we probably won't contact you before October. We will start, as people start giving us information, we just do it first in, first out. So if you're really keen, get us your information, you'll get done first. If you don't proactively contact us, we'll just put you on our list and contact you later in the year, October, November, leading up to that 28th of February deadline. If you're an established fund, so some people have already had a fund that's been running, but they might have come over to us, the deadline is not until May or June. So basically this time next year is when we may be doing some of your accounts. If you set up before 30th of June, the ATO may also request an early deadline. That's mainly for non-compliant funds, and that can usually be the October 31 deadline again, only if you've been naughty, so they want to check on you sooner than later. Hopefully none of you are in that category. Okay, so what do you need to do? Sign the engagement letter, so you're on our list. If you don't sign that engagement letter, you're not on our list. And, if we get time, we may double check with you later next year to say, are you sure you don't want us to do it? But if we don't get time, we won't even be checking on that. So make sure you do sign that so that we know we're going to look after you. Then you can wait for us to contact you, or, as I said, be proactive and send us your information, which is basically all receipts, purchases, investments, costs, everything that we don't know. So we do have your Macquarie Bank statements data feeding to our system, so we don't need the Macquarie Bank statements. Any other bank statements we will need, anything that you've done in that Macquarie Bank account, like buying things, selling things, we need the receipts to show what that was, and a photo of your precious metals on current date. We also need an investment strategy. A lot of people have already asked about this. It is something you do have to do. We will be sending you a templated document in July, probably August at the latest, for you to do that investment strategy yourselves. Unfortunately, government in their wisdom decided that accountants couldn't do it for you. So unfortunately, you do have to do it yourself, but it's quite clear what you need to do, and we can help you for a small fee instead if you do want us to help you. We can't do it, but we can help you. If you want to get the investment strategy done, if you need it for any particular reason before we come to you, once again, email accountants@freedomffs.com.au. So we're leading up to 30th of June, and what I'm saying here is these are the things you need to consider is contributing to the fund before 30th of June. Why? Why would you do that? Well, firstly, to grow your super. You're managing it yourself. So a lot of people were not keen on contributing extra super to the external funds. They felt like it's just giving money away to the cyber cloud that you'll never see again. But when you're managing it yourself, it's a little bit different, because you might want to buy the investments, the gold, silver, property, whatever you want to buy. You might want to buy it in the SMSF, so you can put money in knowing that you are now looking after it yourself. A lot of people also do it for tax deductions, which I'll explain more about. And the reason it's a good idea to build up your super is that it gives you completely tax-free income after age 60. The government has been for a very, very long time. I've been doing SMSFs for 20 plus years. The government has been very proactive providing for your own retirement, because they know that they're running out of money. And for anyone, depending on your generation, it may not be there. The government may not have the money by the time you retire. They've publicly announced that. So they're wanting people to provide for their own retirement, build up their super. So it's a tax-free income after 60, and even still before 60, it's still a reduced tax. So the superannuation is one of the most lucrative environments in Australian tax system. So consider contributing. So there are a few different types of contributions. Firstly, we're going to talk about concessional contributions, which include your employer ones and salary sacrifice. I'm not going to talk about them because they're not 30th of June issues. We do have another video on contributions you can watch. I'll be talking about personal contributions that you can make before 30th of June and catch-up contributions. There's also non-concessional contributions. And there's a 3-year roll forward rule, which I will talk about today. There's other contributions that I'm not going to talk about today, the downsize of the first time super saver, small business concessions, but we do have videos on all of these. I'm only focusing on 30th of June ones. So if you look at YouTube, you can see my other videos. So people come to us and say, well, should I contribute extra? That is where we can't answer that, because I'm no longer a financial planner, and our team here aren't financial planners. We have one we can refer you to, but if you ask them that question, unfortunately, because of ASIC rules and regulations and red tape and government compliance and the inquiry into financial planners and the Royal Commission and you name it, they can't even answer that question without charging you $3,000 to $5,000. So what you can do is watch this webinar and look at my other YouTube videos and decide for yourself on the facts. Look at the facts I'm going to present, and you should be able to decide for yourself whether you should contribute or not. So personal, this is not financial planning advice, but just personally, I believe the decision to contribute revolves around a certain number of things. Firstly, do you have the spare money? If you don't have the spare money, well, that's the end of the conversation. But if you do have spare money, then ask yourself, are you able to lock these funds away to after 60? So for someone, say, younger generation, then perhaps saving for your first home or paying off your mortgage is better than locking it away. But for someone getting closer to retirement, it may well be really worth locking it away for 5 to 10 years to grow your super. Also, what is your tax bracket? So that will come into the tax deductions, which I'll talk about later. Someone on a very high tax bracket, more than 100,000, 120, 150, 200,000 income is more likely to want to contribute to super for the tax deduction. So that's similar. Do you need the tax deduction in your personal return? Some people do want this to save tax. And then is there another reason for your funds, so such as medical, mortgage, family issues that you might need the money for? So if you do have the spare money and you can afford to lock it away and you decide to do it after looking at facts, how do you do it? It's quite easy when you've got a self-managed super fund. You simply put the money in the SMSF bank account. Make sure it's a good few days before 30th of June. Don't leave it to the last minute for two particular reasons. It won't work unless it's in the account by 30th of June. And as always these days with banking, there might be, if you're trying to transfer from one bank to another, you might have transfer limits, daily limits and things. So don't leave it to the last few days or you might find it's too late. But it really is as simple as that. It's just getting the money into that Macquarie account. To make our job easier, it's good practice just to note a reference number. So say Jane's super contribution, just to save us having to ask you, well, whose contribution is that? So you can deposit to that Macquarie account anytime you want, weekly, fortnightly, monthly. For people who like budgeting, this is more going into next year. For now, we're talking about the 30th of June strategies, but maybe next year, rather than a big lump sum near the end of 30th of June, you might want to do it weekly or monthly, just for your own budgeting. But you can just do a one-off end of the year, calculate how much you want to put in and just put it in. But be aware of the contribution limits and don't exceed them, or there are taxes to pay and there's nothing you can do about it. If you put that money in, it's too late. And if you exceed it, you'll have a tax bill. So let's look at those limits. Firstly, there's a few different limits, as I've said, and I just explain them here again. There's one called the concessional limit. There's one called the non-concessional limit. I like referring to them more as the concessional limit is the tax deductible contribution. So you get a tax deduction or your employer gets a tax deduction, but it's taxed in the fund at 15%. There's a non-concessional limit that a lot of people don't know of. It's not tax deductible and it's not taxed in the fund. I'll talk more about these a little bit later, but these are the non-concessional ones, are just where you just want to build up the super. You're not worried about the tax deductions, you just want to put more money into super for the property, for whatever you're looking at investing. There's other ones as well, which I'll talk briefly about. Always refer to the tax office website. The information I'm giving you here today is current as at today's law, but the laws do change. So it's always really good to have a quick look at this website. It does set it out quite nicely for you, so that if this video becomes out of date, you'll see the new limits. So we'll now talk about the concessional contributions, the tax deductible ones. So most people might know of the $27,500 a year per person per year. But it includes your super guarantee charge. So that's really important. If you're working with an employer and they're paying super, let's say you're earning $100,000. I like simple maths. So 10.5% your employer has to pay. So your employer's put in 10.5. The limit's 27,500. Your employer's already done 10.5. That means 17,500 you could contribute by simply putting in the Macquarie account. It's tax deductible against your income or your business profit, and that's why people do this. Just be aware that that 27,500 also includes salary sacrifice. So if people have been doing extra super during the year, that also goes to that limit. And this is quite rare, but for the sake of covering it off completely, any reportable employer super contributions, bonuses, increased super, things like that also need to be taken into account in that limit. Won't apply to majority of you, but just for sake of it. Then before you can claim the tax deduction, so if you go and put extra money into your super before 30th of June, you then also need to do this notice of intent, which is to let the super fund or let your SMSF know that you want to claim a tax deduction. Because the SMSF needs to know that it's a taxable contribution, so there's tax on it. So that's what this is for. This is the form. Very easy to find just by Googling notice of intent to claim, or we will be sending it out in the newsletter next week, or you can contact us for it, but I prefer if you just Google it rather than emailing us for such a simple form. We'll also send it to you if you need it and if you haven't done it. So yeah, as I said, if you haven't done it when we're doing your SMSF accounts, we'll get you to do it, and that's okay. But if you want to lodge your personal return prior to us doing your SMSF return, you need to have done that form. So some people choose just to leave their personal tax return until the SMSF one is done so that we can check off everything. That's fine. We also can do your personal tax returns for you, in which case we'll marry it all together so that it works out well. Just quickly, there's age restrictions. They won't apply to many of you, but if you're over 75, you can only claim the deduction for contributions you made to the 28th day of the month before you turn 75. If you're under 18, you can only claim it against income that you've earned as an employee or business operator. Okay, there's another provision that a lot of people aren't aware of because it's reasonably new. It's called a catch-up provision, where if you haven't used the 27,500 limit in the last 4 years, you can put it all in one go and claim it as a tax deduction. So when I first heard of this provision, my mind immediately went to capital gains. So if you've sold a property or something like that, or shares or any other asset in your personal name and you've got a big tax bill, this can be a really good way of getting rid of it. So I also encourage people, if you're thinking about selling a property in the next year or 2 or 3, plan for this. Maybe minimize your contributions over the few years until you sell the property so that you can use this catch up. It's always good to talk to an accountant before you sell an asset, because there's many ways to reduce the tax. But if you sell the asset and then the financial year ends, then there's nothing that can be done. So always good to talk to accountants about selling assets. Just one thing, your balance needs to be less than 500,000. So the idea of the catch-up provision was for people with low balances, that they could start topping them up. And chat to one of our accountants, because we can also help you calculate exactly how much you can contribute and whether it's worth it and what your capital gain is and all that sort of thing. So chat to one of the accountants. There's another one that's it's not new, but I haven't really heard of it until the new technical team told me about it. You can contribute 27,500 for the 23 year. You can also contribute in advance for the 24 year and claim both of them in your 23 return. And what the accountants do is we either reserve one of those 27,500 contributions for next year. You won't be able to contribute next year though. So this one will be used if you have a high income this year, like capital gain again, or maybe you're in a very high contract job, but next year you won't. You might want to consider this. But should you claim a tax deduction, because it will be taxed in the fund at 15%. So if your income, if you're only earning less than 45,000, your income's a maximum, your tax is a maximum of 19%. It starts to become not really worth contributing if you're on a low income. However, if your income's over 45,000, it is worthwhile to do that contribution, save the tax. One warning for any high income earners watching this: if your income is more than 250,000, you may pay an additional 15% tax. It's still going to be worth you doing it, because it's still going to be better than the 40 to 45, 48% tax rate in your own name. So once again, perhaps have a chat with the accountants. All right, that was concessional contributions. Now we'll talk about the non-concessional contributions. Isn't this stuff fascinating? I've been doing it too long, I think. Non-concessional contributions, once again, they're not tax deductible. So they're coming out of your post-tax dollars and they're tax-free in the fund. The easiest limit is the 110,000, so per person per year. So literally you can just put 110,000 straight into the Macquarie Bank account as a contribution, no problem. You can also roll forward or bring forward 3 years of that. So you could put in 330,000 in 1 year per person. Then you won't be able to put in the 110,000 for the next 2 years. So once again, probably best to chat to one of the accountants, unless you're 100% sure. You can do your own research on the tax office website, but unless you're 100% sure, probably best to chat to one of the accountants after you've signed the engagement letter, because if you get this wrong, there are penalties. So, and I have had it happen in the past where someone made a mistake on this and really did lose a lot of money. Okay, there's a couple of other quick ones, which is the government co-contribution. It's money for free. If you contribute $1,000 and your income, you're on a low income, so your income is less than 43,000, the government will simply throw in $500 for you. So I did use this with my kids. I still do. For the ones that are on low incomes, I just throw in $1,000 for them, and then the government's contributing $500. Or a non-working spouse, or if you're not working, anything like that. If you can afford the $1,000, you get $500 for free. There are a couple of more eligibility criteria, which I didn't want to go into here. Just double check on the ATO website. Another one is the spouse co-contribution. You can put in $3,000 to your spouse's super, and then you can claim a tax offset in your tax return, provided that the requirements are met, which some of them are here. Also double check the ATO website. For the full tax offset, your spouse has to earn $37,000 or less. For a partial tax offset, your spouse has to earn less than $40,000. That's it for contributions for now. So going to move on to withdrawing money through pensions. So that is just as important. These are pre-30 June strategies to consider. So withdrawing money, not for personal use, please. The same rules that apply to all superannuation funds apply to the SMSF. So just because you're managing it doesn't mean you can just take out money whenever you feel like it. You have to meet the rules. So to withdraw money from super, you have to be aware you need to meet a condition of release, and in some situations the withdrawal will be taxed. So you might not want to withdraw, even if you've met the condition of release. The easiest condition of release is reaching age 65. You can access as much of your super as you like after 65, even if you're still working. If you're under 65, but you've reached your preservation age and you permanently retire, i.e. you do not intend to work again for more than 10 hours a week, then you meet a condition of release and you can withdraw. Why the word intend is in red is that just because you do this doesn't mean you can never work again. It just means right now you intend not to work again. You could go back to work again in a few months' time. It's what your intention is right now. A bit blurry there, but on the ATO you'd easily find what we call preservation ages. There's the screen there. Basically, if you're born 1964 or later, for everyone 1964 or later, your age is 60. Before July 60, you're born before July 60, your preservation age is 55, and then there's this sliding scale in between. So you can withdraw under age 60, depending on your date of birth, after you've reached preservation age, but beware of tax payable. There will be still tax payable until you're age 60. So pensions. Why this is an end of 30 June strategy is that some people watching this may not be aware that they probably should be drawing down a pension. So once you're eligible, 60 and retired, or 65, you can set up a pension, paying yourself weekly, monthly, or annually. Or just draw it whenever you want. So some people just Macquarie internet banking, draw out $1,000 here, $500 here, whatever they want, and we account for it as a pension. There's no minimum. Sorry, there is a minimum, there's no maximum. So I'll explain the minimums in a moment. So to be in a pension, you need to draw the minimum required per year. For example, if you're between 60 to 65, to be considered in pension, you need to draw 2% of your account balance each year. But you can draw more than that, as long as it is 2%. These are the percentages now. So under 65, as I said, for the 2023 year and the past few years, it's 2%. 65 to 74 goes up to 2.5%, and so on. There's a sliding scale there. The standard minimum are the normal ones, but in the times of the economic stress that we're going through, the government allow you to withdraw less. You'd sort of think it's the other way around. You'd want to withdraw more, but anyway, you know what the government's like. Why draw a pension though? So some people say to us, yeah, okay, I can withdraw because I'm 60 and I'm retired, but I don't need the money. Why should I withdraw? This is where it's really important. We still recommend you draw the pension when you're 60 and above, because then the earnings in the super fund are entirely tax-free. This is the biggest thing about SMSF, and why I have been promoting SMSF since they first came out, 1999. I've been very, very proactive SMSF since 1999. All the gains you make in here. So let's say you bought an asset, let's say you bought gold and it is skyrocketed. The gain on all that can be tax-free. So, but you have to be in pension mode. So, and this is why this is such an important end of financial year strategy, because if you don't draw the pension before 30th of June, your super fund won't be tax-free. You can even recontribute the money if you don't need it. And I know it sounds crazy, but our clients have been doing this for years, withdrawing all the money just before 30, or withdrawing the minimum required before 30th of June, then recontributing it using some of the contribution thresholds that I used earlier. So even if you didn't have the money to recontribute, you could withdraw it and then recontribute it. So very, very well-known strategy that's been around for a very, very long time. Certainly worth talking to one of the accountants about if you don't fully comprehend this. Even though there's no maximum pension, so you could take everything out after you're 60 and retired. But we suggest leaving it in anyway because it's all tax-free. So if you were to withdraw all your super and invest it in an asset outside super, when you sell it, it's all going to be taxable. Leave it here, it's all tax-free. So what we generally recommend is you withdraw the minimum pension, put the money back in if you don't need it, and just have everything tax-free, but leave as much in super as possible. There's also a transition to retirement. It's not as popular as it used to be. This is if you have met the preservation age, but you're not retired, or you're 60 and not retired. So therefore you can't withdraw because you're not retired. You can take out 10% of your fund, no problem. However, it is taxed, so you might not want to. We still say it's better to wait to age 60 or wait till you retire so that everything's tax-free. But the TRIS pension is available, particularly if anyone's having cash flow difficulties with the cost of living crisis. This is one that might help you out. There are other allowable withdrawals, such as the permanent incapacity, temporary incapacity, terminal medical condition, severe financial hardship, compassionate, and first home saver scheme. I'm not going into them today. I do have another YouTube video. If you Google Cass Smith on YouTube, it all comes up. Just beware on all of those, there's tax payable if you're under 60. So at all times, it is best to wait to 60 if you possibly can. So wrap up again. What do you need to do before 30th of June? You really just need to be signing our engagement letter. And the screen's not forwarding for some reason, but sign our engagement letter. Make contact with the accountants if you're not sure of what to do. Make your contributions if you have any spare money. There we are, it's coming in now. Consider whether you want to make a contribution or a withdrawal, and do so well before 30th of June. And consider your investment strategy. So some people want to get that done sooner than later. You can draft your own. You can Google investment strategy on Google, download a template, draft your own. That is preferable because we're not meant to do it for you, but you can download it, do it your own. All it is saying is, well, me and the trustees, you and your partner, you and whoever else is in the fund, or just yourself, have sat down and decided what you're going to invest in. Be it all gold, be it property, be it whatever you want to invest in. Your investment strategy, you say, yep, this is what I'm going to invest in and this is why, and you sign off on it. That's all. If you want us to do it, we will be sending you a template that you can do yourself, or for a fee, we can help you. Anyway, that is all from me. Thank you for listening. Get your 30th of June affairs into order and make the most of the tax system the way it is at the moment. So thanks, everybody, and I will no doubt see you all again.